very much for being here. I want to talk to you about a shift that a lot of us might be experiencing because, as Julius just said as well, for a long time it's been about sustainability reporting, right? So the reporting has really been driving sort of sustainability in organizations over the last few years, especially with the CSRD directive. And now we're really seeing the shift towards needing to justify why sustainability initiatives need to take place. So because of Omnibus, which I'm sure is a familiar term to most of you, there is a lot more move towards being able to say what value and what measurable value does sustainability actually deliver within an organization, and how can we actually prove that also, because of course decisions need to be made based on that. And we're going to do this in 3 steps. So first, we're going to look at sort of this trend and why it's developed that way, why now sort of this financial value stands in the center of the sustainability question. We're going to then look at the ESG value drivers and how they actually connect to business performance. And then we're going to look into how you can sort of turn an initiative really into a business case. So hopefully there's a lot of also practical information that you can take with you from this. And what's nice about it is that it sort of puts sustainability and finance in the same room, so that hopefully no longer you'll have to constantly sort of fight and justify why you need a certain budget, but instead you actually speak the terms of investment, and it makes it comparable sort of what this sustainability initiative can achieve compared to other investments. Before I dive into that, I want to put a few words on who I am, but also who we are as Position Green, and why we usually approach this topic from both, of course, a data perspective, but also a little bit more a strategic perspective. We consider ourselves a little bit of a one-stop shop for ESG. So you can see here we're made up of both ESG software, but also an advisory arm, which means that we both have sort of the data infrastructure, but we also have sort of more the strategic insights that can connect this data to your business and to the bigger market landscape, essentially. We are originally from Scandinavia, so you'll see here that we're in 9 locations, so heavy footprint in Scandinavia, but we're also in Brussels and London, and also here in Berlin. We've been around for 11 years now, so originally founded by ex-Deloitte employees who said, okay, we can very clearly see where it's going, that we will sooner or later also need data management for non-financial data. So we've actually been around quite a while before CSRD, ESRS was even a thing, and have then moved towards now, of course, also regulation, but very much also still focusing on other parts of sustainability. We're around 200 employees, both on the tech advisory side or more technical software side, and also the more sustainability and strategic advisory. And we have around 1,000 customers, or over 1,000 customers, with very much a global footprint, which also means we're quite familiar with these considerations of, okay, we technically need to report on a European level, but our headquarters are in Japan. They soon need to report according to the Japanese sustainability standards. How do we connect, first of all, the data and avoid duplicated work, but also how does all of that essentially work with the global footprint? As you can see here on the software side, we have sort of the classics, I guess at this point. You've probably seen a lot of the companies having sort of carbon management, sustainability reporting, supplier assessment, then also more plan and strategize, which is more for other sustainability initiatives that don't quite fit into one of the existing frameworks. Academy is very much something you get when you purchase the platform that is all about upskilling yourself, upskilling your team, so a lot of material there as well. And we have investment monitoring. On the advisory side, we span across the board, really from everything related to climate to, of course, reporting and communications, also supply chain, human rights, and then also more the strategic sides and implementation. So how do we actually roll out sustainability in the organization? How do we set up an operating model so that the data actually flows and that it's not the 2 people in the sustainability team sitting there collecting all the data a month before the report needs to be written, essentially. And then sustainability, sustainable investment is also an aspect that we deal with. So essentially what this gives us is a little bit of a broad perspective, because we don't just sit in the data, we actually sit sort of across the organization a lot of the time and really see where these conversations take place. And a lot of the time sitting with our customers thinking about, okay, how can you actually make leadership see that this is something that also helps the bottom line? And that's what we're going to dive into a little bit now. So First of all, as I just said, this shift that is taking place is that, of course, ESG is now a little bit back on the agenda. Omnibus slowly is rolling around where still you need to report, but we see that the questions changed. It's moved very much from, we need to do this because we need to have it in a report, that's what regulation says, more towards leadership asking, okay, but what value is that actually going to create? So what opportunities are we going to unlock? What risk is this going to protect us from? And there's 3 key things that sort of drive this shift. So one is budget scrutiny. Many of you that are ESG managers are probably very, very familiar with the fact that you really need to always fight and sort of make a good argument for why this needs to happen and why it needs to happen now. So it's very difficult as soon as there's less immediate pressure perceived by leadership to keep fighting for certain sustainability initiatives. The other thing is customer pressure. So we also see actually that increasingly in tenders or just for sort of renewal of contracts, there are certain ESG requirements as well. So it could be climate targets, could be specific data that's being asked on your suppliers, for example. So here we really see that this is increasingly also becoming a competitive factor that one needs to deliver on. And then we have the regulatory uncertainty. So again, the big bad word of omnibus, but we really saw a lot of companies that just hit the brake as soon as that went through and said, okay, now we have an extra 2-3 years time, we're going to hold off, and sustainability sort of moved all the way down on the agenda. So that means it's even more important that you have something that is tied to competitiveness, that is tied to risk avoidance, or that is tied to sort of customer market access that actually sort of verifies that sustainability needs to continue in your organization. The way that this can be thought about is essentially through the 5 ESG value levers. So if we go through them, we have access to capital, we have increased revenues, we have the reduction of costs, we have mitigation of risks, and we have the attraction of talent, or generally access to talent. I'm going to go through each of these now. And then you can think a little bit maybe in the back of your head already, what is on your agenda right now and how does that actually tie to each of these value levers? And it doesn't have to tie to every one of them, but usually it's one or more that ideally it should tie to. So when we talk about access to capital, we talk a lot about green loans, we talk about sort of access to cheaper capital essentially, or generally anything related also to your enterprise value. And the belief that you need to test here is essentially whether ESG will positively impact your ability to attract better or cheaper capital. When we talk about increased revenues, it's what I just mentioned a little bit also, of course, the tender success rate, but it could also be competitive differentiation. So maybe you unlock a new market segment or appeal to more people in or customers in your segment because of the certain thing that you are doing. Or it could also just be customer expectations or demands that are increasing, meaning if you want to keep this customer, you need to move along with their expectations. So here it's about testing the belief, does, for example, transitioning towards a lower carbon product actually enhance the win rate of tenders or sort of avoid losing certain customers. The reduction of cost is probably the most well-known one because it's the easiest to quantify. We usually know the costs that we have and we can estimate how much we're going to save. So this a lot of the time is a popular one, especially everyone's focusing on decarbonization. That, of course, a lot of the time comes in here. That's often tied to operational efficiency. It's tied to sort of a reduction in resource consumption, and of course also sort of the streamlining of processes or purely compliance, essentially. And here you need to basically see, does this improvement justify the cost that goes along with? And that's fairly easy to do because you know what is it going to cost most of the time and you know roughly what savings do you expect. Something that's a little trickier and a lot of the time undervalued because it deals with sort of the avoidance of losses is the mitigation of risks. That's a lot more hypothetical. There's no guarantee that it is going to go that way. And here we sort of talk about operational resilience, meaning looking into your supply chain. We talk about future regulation and also reputational risks, of course, that can be quite large. And then lastly, we have access to talent, fairly straightforward. A lot of employers that actually see, okay, if we want to attract talent or retain talent or actually keep them engaged, we need to do something on the sustainability side of things. So it could be that you have lower turnover or you have actually lower recruitment costs because of word of mouth. So something that positively impacts essentially your workforce and the recruitment of them. You see in the bottom here, we have a couple of benchmarks They are not guarantees, but that's sort of to show how you could quantify that. So you need to think a little bit around, in our organization, what would move the needle? What's the number where we say that is actually attractive or that could interest leadership if we are able to quantify it that way? A good test is generally, if a sustainability initiative cannot be connected to at least one of these value levers, it probably is not decision ready yet. That means you should probably, it doesn't mean it's a bad initiative, but it means you probably should go back and think about, okay, how can we perhaps tie it to one of these levers? How can we put something quantitative on it? Because then it's a lot easier to talk to leadership about it than we think maybe it might do that, but we don't really know. Looking into this mitigation of risk example, because this can be quite a tricky one. We see sort of a few market trends here. So one is that in supply chains, actually, we have a huge potential for disruption, of course. I think we've seen it with multiple cases now where ships were stuck in channels, and then we saw it with COVID. So your supply chain is really a big, big area of vulnerability, which also means that you have a significant risk here to run into costs. And a lot of the time, what we see, if you don't have the transparency in your supplier base, it actually only becomes visible once it's an operational problem. And by that point, you're already sitting on costs. So here, it's really all about also making sure you have the transparency in your supply chain. That risk can, for example, look like having limited access to key materials. It can also be that you have increased procurement costs, or actually that you sort of just hit your limit to actually reach your production targets because you're missing certain key materials in here. The other aspect that we also have is now more and more implementation of AI and AI screening. So, for example, in the pharma industry, we see a lot that AI scrubbing is being used. And what that means is that before you might even know that you're part of a tender process, companies already have a long list of sort of suppliers they want to invite for a tender. And what they do is they have certain ESG criteria, and they have AI and just say, you know what, we're going to scan now what you have on your website. We're going to see, do you have a sustainability report? What is in that report? What are you actually communicating? And that means that you might actually already be preliminarily rejected from a tender before you even know that you were part of it. So you don't even get the chance to make a commercial offer, because already by that point they've said, yeah, you're not really delivering on the things we need you to deliver on, and we've got 5 others here who do. So it's also really, really crucial that you communicate publicly about what you do, and that it's sort of visible in these tender processes that you might not even know that you are a part of. Lastly, we have this sort of reactive approach to market development. So a lot of the time we see that ESG is only sort of at the forefront once it's forced there, be that by regulation, or by, for example, a key customer that says you now need to have an EcoVadis score, or that, you know, actually an investor says we now need your full GHG inventory. It's no longer enough to just have scope 1 and 2. So this is usually what drives, or in the past has been what a lot of the time drove ESG in the business. What we see with that, though, is actually that there's a huge burn rate, basically, for the budget. Because speaking from experience as a consultant, a lot of the time that work then goes to consultants, right? Where you're sort of saying, okay, we're now suddenly on a tight budget, we're on a tight timeline. You have very, very limited actually internal upskilling, a lot of fragmented projects. A lot of the time maybe that it's split across the organization, okay, but they've already started working on an ESG strategy, and now you're working specifically on what we should do in the social sort of aspect of the company. So a lot of the time, this actually has a huge cost and very limited long-term value to a company as well. If we look at how to then quantify it, so let's say we've thought of an initiative, we've tied it to a few sustainability value levers, and now we need to think about how do we want to quantify that. The key thing is really to not get stuck on the discussion of the methodology. At the end of the day, it really depends on sort of knowing what matters for this project, but also what does leadership need to make a decision. Very classic, we have the return on investment. So that's usually when you exactly know, okay, it's going to cost us roughly this much, the benefit is going to be that. So let's say energy efficiency project where we know the upfront cost and we expect X amount of savings a year. That you can very easily do with a return on investment. Where it becomes a little bit more interesting is when we move towards sort of also accounting for the indirect financial benefits. So what we just talked about with the value levers, where we then add the ESG, the risk, and the strategic perspective to this as well. Then we have the net present value. That's a lot of the time where the timing of the cash flows matters. So we know that, of course, savings in a year's time aren't quite the same as savings in 10 years' time. And then we have the discounted cash flow and the enterprise value. So that's all about where sustainability or a certain initiative might change factors of your valuation. So it could be your growth rate, could be your margins, could be terminal value that you think is going to be changed by this. So think a little bit around what exactly is this initiative and what do we think it'll do. And based on that, you can usually quantify it with one of these methodologies. But as I also said, the key is really don't get stuck in this kind of discussion. Worst case, try several, see what sort of works best actually, where you sort of run into walls and maybe need to pivot a little bit and choose a different one. But that shouldn't really get you stuck. It's all about just what makes the value logic explicit enough for someone to make a decision based on that. An example here, we have a regenerative agriculture investment. So a global food company that's basically said we're going to invest 100 million into soil restoration, crop rotation, and then basically said, okay, based on this, we see a few value levers where that's going to help us. And that's a good example because it shows exactly that value isn't necessarily just in one spot. It can actually target different things. So here we see, for example, they say, okay, we expect a 3% uplift in revenue from green branding. That means they expect basically either customers are willing to pay more for the product or actually they'll appeal to new customers who are willing to pay for sort of a lower impact option. And that's very much also what they should test. So that's an assumption they need to test. Is there actually that appetite? Are customers going to buy more or be willing to essentially invest more if we do this? Then we have the supply cost over 5 years that they expect to reduce. So here also something that, of course, needs to be checked with the procurement department, with the supplier data that you have. And they also actually expect an improvement in the weighted average cost of capital. So that also very, very business specific. If you don't have anything that you think will actually impact your investment or you're not getting financing in that way, of course, this won't be a relevant factor for you. But what we can see here in the business case is that if you look purely at ROI, only at the direct financial benefits, we look at a 225% improvement. If we look at the integrated ROI, so we now take into account sort of these additional value levers, it's actually 270%. So again, this is just an example. It might look different for you. But what we really see from that when we then take sort of the enterprise value view is that it's actually 22.36% better picture that it paints. And that means if you don't also take these indirect effects into account, you leave a lot of value on the table and you have a much harder time to actually argue why this needs to be done. Key thing here, though, is also you don't want to overclaim, right? You need to make it very clear for management what are our assumptions. You need to sort of separate the known data from the assumptions you make. And of course, a lot of that also requires a little bit of market research. So with this, make it very sort of clear. The more management knows where the uncertainty lies, the more they're comfortable with it. If you come in and you say, this is a done deal, we know it's exactly going to be that way, it'll raise some eyebrows. So you do yourself a favor by really knowing which ones are assumptions, which ones do we need to test. And it's also perfectly fine to go to management and say, hey, we still need to test some of these things. Looking into then how you actually build this business case. So as I said, hopefully you take a little bit of also practical advice from today, and it can be a bit of a challenge. A lot of the time leadership is like, okay, build us a business case, give us all the data, and you're a little bit like, how do I even do that? Where do I start? So you start with basically modeling the scenarios. So really defining, first of all, what is the initiative exactly? Where are the boundaries? You also should define the baseline. That's the key point, because a lot of the time sustainability or a certain initiative is looked at as, okay, but what if we just don't do it? Then we don't have any increased costs and it's fine. But if we look at, for example, the example of tenders, if you don't do a certain thing, there's actually a cost tied to it. So it's not just business as usual and it won't increase your costs if you don't do that initiative. Actually, there could be a negative effect if you don't do a certain thing. So make sure you also know sort of the baseline and the what if we don't do it scenario. And then, of course, investment and time frame also matter. Then we test the drivers. So what I was just saying, stress test your assumptions. Look into, okay, are we sure that these are the costs? How do we know that those are going to be the savings? What about sort of carbon prices and how they're going to rise? What do we know about this? And make very clear sort of what is what. What's fact? What is assumption? Then you quantify the impact. So as we said, choose, is it ROI? Is it NPV that you want to go with? And then here you sort of validate the assumptions, meaning going a step beyond, okay, we think it might go that way, to really try and do some of the research. Speak to maybe your customers. Would they be willing to pay a premium if you did price that into because of a lower carbon footprint or something? Basically find out what does it take to validate the assumptions. And if it doesn't take a huge amount of effort, that's something you can already do before you go and talk to leadership. And then the key thing also is deciding on the next step. So a lot of the time, you see that sustainability initiatives, you're very convinced, you're like, okay, now we know we should do it, we have our drivers, we know what are the assumptions, now let's go. And then you sit in the leadership meeting and they're like, okay, now what? What do you actually need from us? Because actually when you're in that meeting, you should have a very clear idea. Is it maybe a pilot that you want to run? Is it actually more data that you need, where you need sort of the sponsorship to go out and get the data and for people to actually provide you with the data? Is it already a budget that you want allocated? Do you need to engage with suppliers and sort of need approval to go and do that? So you need to really come in with an idea of what do we want to leave the room with and how can they help us get there, essentially. One way to do this, I'll speak to this a little bit, but we've developed an ROI calculator as well, where you can really put in all your drivers, all your assumptions, and then it spits out sort of the different NPV and so on. So you can also see as you change it, how do different factors change. As I said, I'll put that into perspective in a second, but you can really then take sort of really targeted approach for 3 to 5 days, go through this process and see what comes out of it. I want to take a quick look at what it could look like. So I'm just going to run through it briefly, but let's say here we have a manufacturing company or an automotive supplier, and they've now thought of all these different initiatives, and they've tried to tie them to value drivers, just to give you a bit of an idea how that might look for you, for example. So let's say they say, okay, renewable electricity or on-site solar is something we want to pursue. And that means we have lower electricity costs, we have less exposure to volatility, also in the long term, of course, and we're actually reducing our Scope 2 emissions. So, great. Several value levers here that we've attached to that. Similarly with energy efficiency improvements. So you might have lower operating costs, you actually reduce your energy use, and you also overall improve your plant efficiency. If we look at water efficiency and wastewater reduction, here it could be that you have lower utilities and compliance risk in sort of your washing and cooling and painting processes. So if we think about a lot of manufacturing firms in the US, for example, sit in also now increasingly warmer climates where water strain is a huge thing. And there that becomes even more relevant. Then recycled sustainable materials could, of course, be customer demand. So either it is actually something customers are asking for because there's new regulation asking how much of this product is actually recycled material, but it could also be that you actually appeal to a new customer segment here or more of your existing segment that value that. It's also future regulatory readiness because we see again in that area a lot is developing, and also stronger product proposition. Supplier sustainability upgrades are an interesting thing because they're actually across the board sort of. So you work with the sales team, you work with your procurement team, you also work with your own productions team to sort of look at, okay, what are the opportunities in the supply chain that we can actually make improvements? And health and safety is another interesting one because a lot of the time that isn't as such, because it's been around such a long time, it isn't necessarily seen as a sustainability initiative. But we actually see it is under the sort of social umbrella, and it's very closely tied to fewer incidents, less disruption, and stronger operational resilience. So that's just a little bit a quick rundown of what could this look like, and then of course you go into the next step and actually try and quantify that. One thing that I would really like you to take away from today, if it's anything, is the boardroom test. So before you have your initiative and you take it into the boardroom, think about sort of these four different steps. First one, really, what value lever are we targeting? So as I said, it could be that it's just one. It could also be that it's several. So really think through, are we missing anything here? Are there any others that we could speak to? Also think about which ones are actually which one is the primary one. So if we're saying, okay, the key thing is actually we're going to reduce our footprint and we're going to have lower energy cost, for example, but then it might actually be a nice buy effect that also appeals positively to your employees. So really think about what's the key one that really drives the point home towards leadership and what are sort of the secondary ones, perhaps. Then we have this whole beliefs, so what I talked about, assumptions, right? So really making sure you know what is the fact, what can you back up with the data versus where have you made certain assumptions. And really test already what you can. So be that speaking to your suppliers, be that internally, basically doing the research and have a very clear overview of where do the assumptions come in, where does uncertainty come in, where you really need to make sure the leadership, hey, this is what we work with right now, but we need to verify it. They're a lot more comfortable then with that as if you present the complete case and say it's a certainty. As I said, cost of inaction. What if you don't do it? So it could be that you are sitting on this sort of huge tender that's going to lose you, I don't know, we've had it with pharma, for example, several million euros, where you're saying, if we don't have a science-based targets, we are going to lose this. And then it's very, very clear you are going to do it, whatever it costs. Still, of course, look at what are then also the other positive impacts maybe of setting science-based targets. But the focus here very much being on, if we don't do it, is there anything negative that is going to come? Look at future regulation, look a little bit at your supply chain, maybe what has already occurred several times where you can say, okay, we see this increasingly becoming an issue, where that becomes relevant. It could also be that you do a climate scenario analysis and you see, ooh, there's a huge risk here if we don't move on this certain area in a few years' time, we're going to have issues. So that's really crucial here. And then lastly, of course, as I just said, decision. So think about what is it you want to leave the room with. Is it what I said before, sort of that you need a budget approval? Is it that you want them to sort of sponsor you and you just need the mandate within the organization to do further research? So try and go through this boardroom test with your initiative once you've gone through all the previous steps and really make sure you have everything in order. And then hopefully it gives you a really, really good starting point to discuss with leadership and argue for why this needs to happen, besides just regulation as asking for it or pushing us to do it. So you a little bit more speak their language and you really avoid sustainability being seen as a cost center and instead speak a lot more sort of this language that compares sustainability initiatives to other investments. So it really brings sustainability and finance into the same room, essentially. You can scan the ROI calculator here if you want to try it yourself. As I said, essentially you put in all your key assumptions, you put in your drivers, and then it really spits out basically your total overall sort of value that you would expect, be that in ROI, be that in net present value. It also takes into account essentially the payback period, also carbon tax savings, for example, which can be quite significant for some companies. Try it out. I think we're tight on time. If you have any questions, we're just around the corner, so I'd be very happy to talk to you a little bit more. But I hope that this also gives you a little bit of a more pragmatic way on how to actually approach sustainability and sell it internally as really value adding and not no longer sort of sitting on, yeah, we need budget because CSRD, but really being able to sort of drive forward and justify this is why we need to do it and how it actually delivers value. Thank you very much, everyone.
Jonna, thank you so much. The room is bursting. Can you just repeat it one more time? If I have questions, where can I find you?
Yes, it's literally, I don't know our stall number, but it's literally around that corner, 20 meters. You'll find us.
Awesome. Thank you so much.
Perfect.
If you liked what you've heard here on stage, feel free to vote for Jonna with the Speaker Awards in the app. And then thank you so much, and you get another round of applause. Jonna Zede, thank you.